I love it, right? It's extremely fascinating. I think there's actually use cases. It's almost like a testing grounds for the future of finance to a certain extent. I think in 2017, you had these large scale ICOs with the mentality of, give us money and we'll build something you'll use in the future, perhaps. Now with DeFi, what we're actually seeing is the mentality of use your actual products that are live that you can actually physically use. And in exchange for using it, we'll compensate you with these native tokens, right? And I think that's a much better economic model, much better customer, investor, a team relationship for the general crypto ecosystem, right?
Layer 1 is a podcast and community dedicated to helping you master all things crypto. We'll be bringing you the best interviews with project executives, technical analysis for trading of the most popular cryptocurrencies, and insight into what's actually happening behind the scenes.
As you join us each episode, you're going to hear about tokens, fundraisers, investments, and even crypto conspiracies. But please remember that nothing we say should be considered financial or legal advice.
Come join us on this journey, and welcome to Layer 1. Good morning, good evening, good night. It's another episode of Layer 1. We got a packed episode here. We have Dimitri, I'm sitting here with. We have Shiliang Tang, Chief Investment Officer from LedgerPrime. We are going to have a great episode ourselves here. We're going to talk options. We're going to talk DeFi. We're going to talk market making in crypto. This is definitely going to be one of those episodes where Dimitri takes the lead, kind of like our episode with Kane and Synthetics. So Dimitri, before we get to Shiliang, how are you doing?
Yeah, I'm doing great. I'm super excited. Obviously, the topics that we're going to be covering is, something that I'm very interested in, and passionate about. So I'm looking to learn more, from, his side, kind of like the institutional side, the market making side, the prime side that we don't really get much information of in crypto in general. So maybe we can get some insights into how that structure is running, in that sector. So I'm super excited.
We did want to thank everybody out there that's been following and listening along with Layer 1. Shout out to our lads community as well. You guys are really killing it, and we appreciate all the support that you guys have given us up to this point. So without further ado, Shiliang, how you doing?
Great. Yeah, it's great to be here, and thanks again for having me. Really excited.
Yeah, we were talking about pre-episode how you're living up there in New York, and you kind of took a stretch on Long Island a little bit this past month. How are you doing with all the craziness that is 2020?
Yeah, I think we're all dealing with it, but I think at this point, 3 or 4 months in, we've gotten accustomed to it and kind of resigned to the fact that, this is the new normal. And at the end of the day, I think, we're all lucky, right? You guys, me, we're still employed and, still have a home and healthy and well. So, the world could be a lot worse for us. So I think, generally just thankful for that.
Absolutely. Those are good words to get us started. So usually we like to get started by, talking about your background. I want to read something from Shiliang's Twitter. He says he's the previously co-founder of World Cover, NYC for life. These are my opinions and probably wrong. So I want to break for your background. I want you to break down your Twitter bio for us. So everything before crypto as well as when you got in.
Yeah. Started my career in traditional finance. Honestly, didn't study finance much at all. And that's honestly a typical path to Wall Street for a lot of quants. Went to a technical college, MIT, and studied engineering and kind of realized I didn't want to do engineering. And finance back then, this is pre-2008, was kind of this bubbling, hot field for young people like me. And so I was, employed by a quantitative trading desk. I didn't need to know about valuations or stocks or anything really, just, did I understand the math? Could I program? Could I do back tests? And over time, I'll pick it up. And so I joined a desk called Automated Market Making. This was back at Merrill Lynch, Principal Investment Group. Basically using the firm's money, we're doing high frequency trading, algorithmic trading, market making, mostly in the derivative space. And this, this world still exists this day. I think it's come to the surface a bit more, through through books like, Flash Boys and a bit more mainstream. That's essentially what I did, previously before crypto. And that's what my team and I did as well. Johannes, my CTO at LedgerPrime, we used to work together back at Merrill Lynch. We stayed in touch. And so we've ported a lot of these similar strategies. Now that crypto is liquid enough and built out a bit more, we've taken and ported these strategies over to crypto.
Nice.
I did, and regarding the world cover mention, that was a few years I took off from traditional finance. World cover is still existent. I'm still an advisor. I was a co-founder and previous COO, but it's a parametric insurance company, and so what we did was we take satellite data, so like rainfall data, and we basically package it into parametric contracts. So for example, an example would be, if it doesn't rain for 10 days in a row, the contract would pay out a certain amount. And we found this huge hole, especially in developing countries, for smallholder farmers. Essentially, their biggest kind of value and their biggest income is from smallholder farming, right? And so insurance for them, that doesn't exist, and it still doesn't really, to a certain extent. And we found that this is a way that we could provide it to them, via technology, via mobile money. And yeah, it was a tremendous, interesting experience. I traveled to Africa every month, Ghana, Kenya, Uganda, went into the villages and smaller farming communities, try to sell parametric insurance, which is a very difficult proposition. But after 3-ish years of doing that, I think it was generally just time to move on. And crypto was always something that I'd been personally interested in and personally dabbled in since 2012, 2013. And it got into a period in its life where it became a lot more mainstream in 2017, and right time, right place. Got linked to some people at LedgerX and Ledger Holdings. And they wanted to back me to start a market making proprietary trading firm. And so I went with it. Yeah.
Nice. Yeah, that's awesome. It's always interesting to hear the background, somebody that did not necessarily study finance, right, and got into the trading side. There's so many stories that I hear where, quants that get into these firms, like let's say to build a desk, they generally want to look for somebody in the background, just math, right? They don't want to have them, with the background in finance, because there may be some bias that they might have, or some things that they've learned that can spill over into the data and so on. So that's very interesting, to know that you went that route, and that experience is obviously, it's pretty fascinating. So as far as the LedgerPrime goes, so for our listeners that, kind of understand, right? So you have different platforms, so you can trade on like futures, derivatives and so on, right? Where does LedgerPrime kind of fit in the whole structure? What exactly, it's a fund, right? But you guys do market making, like, can you tell us more a little bit about?
Yeah. So, we started out as managing the holding company's capital. So just on a proprietary trading basis, market making on LedgerX, as well as the various other exchanges. So providing liquidity to the participants on the exchanges that want to trade, both electronically and in large blocks. And we continue to do that, even though we essentially raised outside capital, brought in outside capital, and basically, for all intents and purposes, we were just another quantitative hedge fund or asset manager at the moment. And so we trade on LedgerX, but we trade on the various other exchanges like Deribit or OKEX, Huobi, and these various exchanges around the world. We focus a lot on derivatives, just kind of taking a playbook from traditional assets. Generally, the derivatives markets, as an asset class matures, they trade 30, 50, 100x the size of, spot markets, right? And so back in 2017, 2018, we held the belief that crypto would be no different in the future. And so we made kind of the conscientious decision to really, invest and focus more on the derivative side of things, even though back then it was, still very nascent and new. within crypto, and it was still mostly the spot markets. And so now, we definitely are continuing to invest and try to build out the derivative space. We trade electronically, but we also facilitate and create products for miners, Bitcoin hodlers, lenders, and borrowers. And so, yeah, I think, any facet that in the space where, derivatives could play a role, we try to embed ourselves in.
Nice. Yeah, no, that's awesome. And obviously, having more market makers, more efficient market makers overall makes the market more liquid, more efficient, and so on, which is something that's definitely, needed. I wanted to ask you, with that being said, you guys are in the market making, and what we've experienced, kind of like on that Black Thursday, where we saw liquidity dry up, right, significantly, especially also on some exchanges where maybe the trading was halted altogether. What's kind of, I want to hear your side of it. What did you guys see when that was occurring? Because it seemed like a lot of market makers were actually pulling out, right, or widening the spreads, right, to manage the risk and the volatility that was at hand, which essentially kind of, increased the gap in of the price, and we started overshooting, the market price that, essentially will probably bottom out, as far as the interest goes from the market participants. So kind of tell me, what you saw from your end as this was kind of happening.
Right. Well, I mean, this again, that whole day or 2-day period just kind of reminded me of what happened back in 2010 during the flash crash in kind of traditional markets and traditional equity markets, when, you had large cap blue chip names like GE trading down 50, 75%. No different, right? I think when there's a ton of volatility, at the end of the day, market makers aren't behooving necessarily to quote. Yes, in traditional markets, there's a greater obligation in terms of market making programs. You could be fined for not providing orderly markets, but when stocks and everything are moving 10, 20, 50%, at the end of the day, you almost rather take the fine, right? And as opposed to getting hurt and providing liquidity. And I think in crypto, when you don't even have these guardrails in place, it's kind of exacerbated, right? And so, particularly on that day, I think for a lot of the leveraged, unregulated exchanges like BitMEX or Deribit, they're just, when things were kind of just cascading down in terms of the liquidations, the market makers, it was kind of like the perfect catalyst, right? Like the blockchain was kind of jammed. Like you couldn't move collateral fast enough onto the exchanges, even if you wanted to. You had rolling cascades from the lenders in the spot markets. A lot of these lenders were liquidating collateral as quickly as they could because they had loans outstanding to the borrowers, and as the price of the collateral goes down, they kind of had to continue to sell spot. BitMEX liquidations, right, as it goes down, the value of the collateral on these exchanges goes down as well, and that further cascades down. And even for us, right, in the options markets, what are you really pricing things to when an asset class gaps down 50%, right? Well, what is the real implied vol? What is the true implied vol? And then with the options market itself, especially when you're using leverage, let's say on a Deribit exchange, how can you even liquidate it, right? Because the options markets are a fraction of the liquidity, of futures or spot or perpetual exchanges like BitMEX. And so even if you wanted to liquidate a person's position because their equity was at zero, a lot of times, you couldn't, right, on Deribit, because there was simply no market to liquidate into. And so a lot of liquidations actually happened in the options space over a span of, days, as opposed to on BitMEX where, it was kind of instantaneous. But yeah, I mean, it was a hell of a 24-hour period. But crypto survived as it always has done, and I think a lot of exchanges and participants have learned a great deal from it. And I think there's a ton of great new products that are being built to kind of alleviate this. I think spot markets are fungible, but derivatives aren't. You could be long on BitMEX, short on CME, long, short, OTC, but your positions don't net. And so there's a lot of products that are being built to kind of help alleviate this, like X margin or copper. So I think we've all learned a great deal from this, and have really come out of this knowing what really needs to be built to really fortify and grow the space.
I'm glad that we brought up this event back in March, because I do feel like Bitcoin's gone through multiple narratives, obviously throughout its lifespan, and people bring this up as a discussion point all the time. But for the longest time, or at least in most recent times, it's been known as like, hey, this is going to be a hedge against the current traditional markets. And what we saw in that environment was that it actually took a super risk on approach, and people were just absolutely trying to get out of Bitcoin to try to be liquid in fiat, and that kind of went up against the narrative of what we have all kind of been pushing, was that when these traditional finance kind of markets collapse, or at least in a sense collapse, people will flee into Bitcoin, and that just didn't happen. So what do you make of Bitcoin's narrative now, after having gone through what it went through in March? Certainly you said that it did survive, and things tend to get stronger if they survive events like that. But what do you make of that Bitcoin narrative now?
Yeah, I think there's you can examine it on a day-to-day basis, and you can examine a longer term time frame, right? I think again, looking through history, back in 2008 during the initial global kind of asset sell-off, gold, which obviously is something we all think of as a safe haven. Even gold in 2008 sold off initially, heavily, right? It was a liquidity event, global liquidity event, and really any asset class, dollar was king, and really any asset class that could be sold, sold off, right? But we did see afterwards was, in 2009 and subsequent crises like the Greek debt crisis, the Greece debt crisis, gold as a store of value, actually started to, hold true, started to appreciate faster than currencies, relative to currencies. And so I think that Bitcoin, the March event, to a certain extent, it was almost like the gold event in 2008 for it. And I do think that in subsequent, perhaps, events, especially ones that are tied to government debt, which, is very, very plausible given what's been happening on a global front in terms of just, a ton of stimulus. I do think that Bitcoin will perhaps hold itself a bit better than it did, back in March. Now, on a day-to-day basis, the correlation actually is still pretty high on a high-frequency basis, right? We're quant traders. We look at the data. The co-integration between SPX and BTC is very tradable. And I think actually a lot of it is a self-fulfilling prophecy, and that a lot of these trading firms like ourselves, or quant firms, traditional asset, quant firms that do trade Bitcoin, like the ones in Chicago and whatnot, they pick up the relationship, and they actually make it a self-fulfilling prophecy, and trade it as if the relationship should hold and will hold in the future. And until the supply of trading capital, until the supply of general investment capital can overwhelm the short-term capital that exists from the trading firms, I think this relationship actually probably will hold on a intraday basis, right? And you actually do see the relationship break down over certain parts of the day. I think especially U.S. Hours, the relationship holds especially true. You see the correlation and co-integration break down a little bit, overnight during Asian hours. So it's extremely interesting. The relationship is there, but I do think that over the long term, we'll see Bitcoin strengthen a bit.
What is going to be kind of the catalyst there, right, to break that away? Is it just something, what you explained, where we see continuous basically printing, and so on, right? Inflation of fiat, where fiat is actually dropping in value, inflation starts coming out, and all these things. And then we start seeing the break of that correlation. Or what do you think is, what is going to cause that break for correlation, on the longer term?
Yeah, I think, at the end of the day, it's all capital driven, right? You need to have quote unquote strong hands. You need to have capital that's willing to hold it through these events, more so than kind of the sell pressure, right? It's at the end of the day, just supply and demand. And so I think March happened and COVID happened so quickly that really no one had any time to kind of process it. And really it was just, sell everything you can, get the dollars as quickly as you can. You had subsequently you had inflation, with the stimulus, and going on in a lot of these third world countries. And so I think over the longer term, as people kind of process the information, as countries, that are not the United States, but countries where they have very shaky monetary systems in place. I think as that capital starts to tilt towards either the stablecoin markets or Bitcoin, that capital will become a lot stickier, and I think eventually will overwhelm the short-termism of the money that kind of flows in and out of the system from crisis to crisis. So I think as more institutions come in, as more real demand from some of these third world countries, that supply of capital will eventually overwhelm some of the short-term supply that inevitably occurs every crisis.
Yeah, absolutely. I love that discussion. We talk about it on the channel, almost all the time, where it's, those distressed countries where there's really, pretty significant demand there, but there's also kind of the lack of on-ramping tools that are available at the moment. So sometimes they turn into, to some of the OTC providers that might be charging a really heavy premium and so on at the moment, which kind of, undermines and slows down the demand. And maybe you have some regulatory side of it as well that tries to cramp down and, stop the, outflow of capital out of the country and kind of keep those people as a hostage in the economy that is really struggling. So absolutely, once the kind of the gates, continue to unlock there and people start to, move into stable coins, I completely agree, Bitcoin, all those things can definitely, as a long-term can break that correlation for sure. So in regards to options, I wanted to talk to you about some of the tools that are coming into the market right now for BTC, and you mentioned that now we're kind of have certain things that will help out if we do have an event where liquidity starts drying up, might not be that excessive, but a lot of people typically when they talk about options, I've saw this on everywhere. There's so many headlines where it's like we have this huge expiration of over 1 billion of options expiring on Friday. Everybody's expecting this huge volatility, fireworks, and so on, right? But it seems like nothing really happened, right? Volatility was very low during that day, during the expiration. It went smoothly. It seems like people might not be understanding options and what the value is there, what they're supposed to do. Can you tell us a little bit what is kind of the options purpose for the crypto markets? Is it supposed to kind of benefit the overall crypto markets, or is it supposed to increase the volatility because it's kind of leverage as well, right? Give me an insight on that.
Yeah. I mean, I think at the end of the day, options are a tool, right? Some people would say anything that provides additional leverage to the system is inherently bad, but I don't think that's necessarily true, right? I think it could be good, used for good, used for bad. It's a tool in itself. It's neutral. How you use it, determines its effect on overall financial system, right? And so, for options, for me, I think it can be used, at least in the crypto space, currently. An example is just hedging, right? It dampens kind of your cash flow, let's say, or exposure to Bitcoin, the volatility of Bitcoin, right? And so a very, very simple use case will be, let's say you're a miner, you have a break even, I don't know, at 6K or 7K Bitcoin price, that below that price, you're basically be, unprofitable. And so a very simple strategy could simply be, buying puts to protect your downside in the case that Bitcoin does, go below 6K or 5K or 4K, which we saw back in March. And we did see miners, do that before the event and then protect themselves. And that, essentially, acts as an insurance policy for your entity's cash flow and protects your downside, right? Another one is yield products. This has been extremely popular in crypto, but also really comes from traditional assets, right? I think everyone loves, some sort of yield, especially in this global environment where, assets, risk-free assets are generating, 0% interest. And so when you sell an option, you collect a premium up front. If it expires out of the money, you keep that premium, right? And so that's, extremely attractive for a lot of participants that are sitting a lot of dollars or sitting a lot of crypto. and they can actually write, quote unquote insurance policies, or in this case, really options, and collect that yield up front, which can, given the high volatility and prices of Bitcoin and subsequently Bitcoin options, they can collect something on the annualized basis of 20% or even more, right? So that's extremely attractive. It's not risk free, certainly not risk free at all, but that kind of yield is definitely attractive for a lot of individuals and entities in this space, right? These structured products are extremely popular in Asia in traditional assets, in Korea and Hong Kong. They're well versed in it. They know about it extremely well, and so you actually see a lot of these structured products actually be introduced from a lot of the Asian firms, into crypto, and very, very popular for investors, for lenders and borrowers, and so that's another kind of use case for options that we've seen, definitely.
Yeah, I'd love to get your opinion here on East and West markets and your opinion on how they're different, how they're the same. But I did kind of want to touch on this institutionalization that we always hear about crypto. I feel like there's kind of two sides to this story. Obviously, there's the people that think, oh, institutions bring more liquidity, institutions bring so much positivity and things to Bitcoin, so much notoriety. But there's also the other side that kind of view institutions maybe as predators. And I wonder where you stand in this kind of debate of as we lay out that infrastructure, as more institutions get into crypto and the broader blockchain industry, what, to the person at home, what does that mean? Is that a good thing? Is that a bad thing? What is your take here?
Yeah, I think right now, crypto, it's still, in the grand scheme of things compared to other asset classes, extremely new, extremely nascent. I think the infrastructure is still being built up. And so my view is that, we still need to make the pie bigger, and it's not a zero-sum game, right? It's not like if institutions get into the space, they're going to take all the retail money and retail is going to keep losing money. I think what will happen is, as more institutional money gets invested into the space, it'll make markets a lot more efficient. It'll introduce more products, better products like ETFs, eventually, hopefully, other indices, and provide better, opportunities for investment and hedging and exposure, for retail, right, into the space. And so that hopefully will decrease spreads, increase liquidity, which ultimately will benefit, the retail traders and investors. Now, yes, at some point, when institutional money and capital overwhelms the space, certainly, that can mean that retail strategies might not work, as well anymore. But I think we're still a bit ways away from that.
Yeah, absolutely. Yeah, I agree. And I come from Forex background, so that market is well saturated, obviously, compared to crypto. And just seeing the things that we're experiencing in crypto in terms of spreads and different quotes that come from different exchanges and so on, right? That still is kind of, shows the inefficiency a little bit in the market. But, like you said, if those, if the infrastructure is there, if institutional players build it out, then it's going to attract bigger players to get in and to play with those tools that are there. So, I completely agree with you, on that point. So I think the predatory side of it is quite far for now, right? As far as the retail goes. So, as far as like, the market making side goes, I wanted to get your take on what are some of the challenges you guys are seeing in market making crypto right now compared to other markets that you have done in the past? Is there like challenges that you guys overcame, or you still kind of see that they need to be fixed, to make the market overall efficient? What is kind of the high risk challenges that you see right now?
Yeah. I mean, I would say actually it's evolved a lot quicker. We started in 2017 in this space, and now it's 2020. In 3 years, I would say the markets has evolved and changed substantially, right? Probably faster than I even expected. Back in 2017, it was pretty easy. Market making, exchange arbitrage was wildly inefficient. You could move crypto around manually and make money and across different exchanges. That's largely, disappeared. We've seen a lot of, better exchanges, come up. I think there's certainly still a ton of wash trading or bad data. but a lot of that has disappeared as well, right? Especially on the top exchanges, like Coinbase of the world. And so the space has improved, tremendously, right? But we're still seeing, issues where, and these are things that you won't encounter in traditional assets or traditional exchanges, where there's exchange overloads that happen whenever there's like a price spike. And I'm not talking about like a March 12th price spike, the market goes down for them. I'm talking about just normal weekly price spikes. A lot of exchanges get held up, and you can't send orders, or you lose orders. A lot of simple things that traditional exchanges and infrastructure have existed for decades, just aren't there in crypto yet, right? And so that's a huge issue for us, especially when we're managing institutional money. That I think is a big issue, and we're still dealing with data quality issues. Obviously, there's a lot of data providers out there that are helping, but just overall simple tools that are needed to really make the space more resilient and make institutions comfortable, I think still need to be improved quite a bit.
Yeah, absolutely. And, data is obviously a hot topic, of course, when it comes to trading, and, curating the data or filtering the data is something that, a lot of participants in the industry have been struggling, right? Because there's so much noise, there's so much like wash trading that happens. But you're right, right now it's coming, it's less than before. So we're slowly making our way, towards kind of like the accurate data, and we're having more like exchanges that are being regulated, that being watched, and so on. I wanted to get your take on that side. So it's we do have these centralized exchanges that are regulated. We have centralized exchanges that are somewhat regulated in certain jurisdictions, and the laws are kind of different there, so they can do different things. And then there's also the decentralized exchanges, right? So three parts there, and what do you think it would be the most efficient way for us to kind of move forward to create the structure for institutions? Is it, to have a combination of all three players, or is it maybe more DEXs than, regulated U.S. exchanges, or maybe outside of U.S. exchanges? And how do if we do get a combination of them to work all together, how do we do that? Because kind of regulators are like, don't really want to work with certain exchanges because they're in certain countries that maybe have, I don't know, sanctions or whatnot, or DEXs that don't have KYC and all that jazz, right? So what is your perspective? Do you think we're going to move into like maybe like centralized exchanges, and we'll see US basically start coming up as a kind of major player of liquidity providing and trading, that will start kind of really, we've been competing with Asia for a while, but really making a run for it, and start creating an ecosystem here?
Yeah, I think I don't necessarily come from the FX world, but I think a lot of what the space has evolved into and is going towards is kind of the FX markets, where you're going to have a ton of liquidity venues, large and small. Some are centralized, some are not. And I don't see why crypto can't evolve into that kind of world, right? I think the large institutions like Tudor Investments or some of these other multi-billion-dollar investment firms, they're probably only going to trade on the CME or U.S. regulated exchanges, and that's completely fine, right? But for an average retail investor, it's extremely hard for them to trade on the CME. Let's say for CME options, right? You need an FCM relationship, or you need to sign up for a brokerage that actually supports it, which sometimes is pretty difficult. And so they're going to go towards these smaller, more retail-focused, exchanges, right? And then you have U.S. versus non-U.S. citizens, like they can't participate on derivatives or some of these unregulated exchanges that are banning, U.S. citizens, right? And so they have to go towards the LedgerX's and some of these regulated U.S. exchanges. And then on top of it, you have people in third world countries, like in Venezuela or pockets of Africa, where they don't even have the on-ramps or these kind of centralized even retail exchanges, and so they have to use local Bitcoin or Paxful and some of these peer-to-peer exchanges to get exposure to crypto, right? And so, I think there's definitely value proposition for all these, liquidity providers and exchanges and venues throughout the world. We're never going to see a world where we're going to have global regulations that are, the same, for crypto, really for anything. And so what we'll see is the crypto industry, evolve and adapt to these, pockets of customers and retail. But at the end of the day, Bitcoin is global. It's fungible. How you get on it and off it, perhaps is less important.
Yeah, we made it 40 minutes into the episode, so I kind of want to warn you. We're going to throw some DeFi questions at you right now. Obviously, you knew you were going to get some, so kind of just like want to break down your general thoughts on DeFi. Maybe, I think we've seen over the past week that even some centralized platforms, some centralized lending and borrowing providers are getting into the DeFi space as well. So I wonder, like, what do you make of DeFi as a whole and its sustainability, as well as maybe kind of the idea that they've been gamifying liquidity, just from your background as a market maker?
Yeah. I'm definitely not an expert in the DeFi space, but I think I love it, right? It's extremely fascinating. I think there's actually use cases. It's almost like a testing grounds for the future of finance to a certain extent. I think in 2017, you had these large scale ICOs with the mentality of, give us money and we'll build something you'll use in the future, perhaps. Now with DeFi, what we're actually seeing is the mentality of use our actual products that are live that you can actually physically use. And in exchange for using it, we'll compensate you with these native tokens, right? And I think that's a much better economic model, much better customer, investor, a team relationship for the general crypto ecosystem, right? And so I think it's awesome. Do I think that institutional large scale investors will get into this space? Probably not immediately. I think it's not necessarily scalable past the hundreds of thousands to low millions. And so, there's still a ton of risk in terms of smart contract hacks or gaming that can be done, as we saw in Balance or DeForce. And so, there's no insurance. And so I don't think the large institutions will feel comfortable yet. But I think it's great for crypto native traders, funds, retail investors, VCs. So yeah, I mean, as a space, I think it's great. And then you have, looking away from just the pure speculative DeFi products, even today, right? Like the Aave team announced, on-chain credit delegation, which is, pretty awesome. Any two parties can enter into like a trusted agreement in which the depositors' capital can be borrowed by the counterparty, and you have like interest rates and loan terms and covenants, baked into this open law agreement, and hashed on chain, and ultimately growing to this system where any two parties can enter a peer-to-peer agreement with kind of a fixed term and entirely permissionless fashion. This is actually a real use case. It's not just for speculation. So yeah, it's wildly exciting.
Yeah, I love that you brought up Aave's credit system that kind of just rolled out, and I want to have this discussion really quick and get your take on it. I've seen some people talk about this credit system of being decentralized. Is how do you enforce maybe something that someone that probably defaults on a borrow, right? Like usually if you're going to default here from like a bank, obviously you have the government that's going to come here and get you basically if you don't make the payments or you don't do what's necessary. But in a decentralized system, you obviously have the reputation involved. But if something like, let's say, a dispute happens, how does that get solved on a actual physical basis? I wonder what you think about that.
Yeah. I mean, to be honest, I don't know the answer. Right? I think everyone is going to use it as a testing ground to figure out these corner cases. I do think that social credit scoring is a lot more powerful than one perhaps thinks. I think especially in this world where, the world is essentially flat with kind of global internet access and everyone kind of go on social media. You have the whole, quote unquote, cancel culture and everything that's going on in the space. I think social scoring and kind of your social reputation is extremely, extremely important, especially for larger institutions. And so I think that by itself will play an important role, in kind of growing this space. Now, yeah, if you're talking about getting to the nitty gritty of laws and corner cases where, even in today's world where you have contracts that are hundreds of pages long, and still at the end of the day, when someone defaults, you still have to go to a court of law and figure out, who's right, who's wrong. It's going to be difficult to kind of bring all of that, on chain. But I think, what they're intending to do is starting small with kind of very either, small size loans with kind of small retail, or with well-known established crypto institutions. But yeah, if you're talking about like the Wells Fargos and Bank of Americas of the world, making large-scale business loans on chain, I think that's going to be a whiles away.
Yeah, so I've loved this discussion, I love that you brought this up, because that kind of reminds me of like the default swaps, right? That we kind of had, in traditional finance, that are in place. So it's going to be a different kind of experiment there. We'll see how it's going to, affect the market. But what I wanted to also ask you, how you mentioned that, DeFi, institutions might not want to get into DeFi because of, insurance fund or insurance that is available there. And also, perhaps, some of these smart contracts are still getting kind of hacked. So there's the vulnerability factor in there. But, what does it take overall if we do get volatility, significant volatility, and margin calls start rolling in through these DeFi products, and so on, right? Is it possible? Is there a risk that, we might experience something that might trickle down in the spot market where, the liquidity dries up and those, basically positions will not be able to unwind quickly enough, especially, how fast it's grown so now, right, compared to where we've been. Do you think there's still, a high risk if the volatility does pick up, this might occur and impact the DeFi space?
Yeah, absolutely. I think if you think that, market makers are, they have, and I think market makers are going to step away on the centralized exchanges during pockets of volatility, which they've demonstrated that they have. Absolutely, they're going to step away, in kind of decentralized exchanges as well, during these pockets of volatility. And so, yeah, absolutely, you're going to be, susceptible to these issues that, you haven't even figured out necessarily on centralized exchanges. So yeah, I think that without a doubt would happen. Now, whether that's going to impact the broader crypto system, I don't think so. I think DeFi and decentralized exchanges as a percentage of volume or liquidity, it's still fairly small. Just as people question whether crypto would actually, the collapse of crypto would actually, affect traditional asset markets. I think overall, DeFi to crypto is still pretty small. So if it were to happen tomorrow in the near term, I don't think necessarily it will affect, global stock markets. I do think that it'll be, harmful to confidence in terms of the evolution of the space. But overall, to Bitcoin, I don't think it'll be a huge effect.
Got it. Yeah. No. Thanks. For sharing that. It seems like you keep kind of repeating the side of market makers where if things hit the fan, the market makers are dipping out. So like it's interesting because you mentioned in traditional finance we have something different, right? There's different structures. Like for example, in FX, when we work with multiple liquidity providers, there's like a point system, right? You have to take X amount of orders. If you don't take them, then you're going to be in back of a line. So and we don't really have that right in crypto, and there's other things that we have in traditional finance like seed belts and so on, right, to kind of prevent like cascading liquidations and volatility and so on. Do you think that some of those tools are going to be ported over and eventually we're going to move into something like this in crypto, where we're going to have a point system grading for the liquidity providers and seed belts and all these things that would kind of help the whole system run efficiently? Or is it still going to be kind of the Wild West,
No, I think, even simple things like a speed bump on exchanges, right? I'm not talking about like a global halting of trading of crypto, but I think a speed bump, let's say on even like BitMEX in terms of what happened. I mean, it was kind of like artificial speed bump that happened when they took the exchange down back in March 12th. But like even just having speed bumps on various exchanges when pockets of volatility happen and liquidity vanishes, I think will be extremely beneficial, right? I think a lot of the times it's not market makers just saying automatically that they're going to leave and not provide liquidity when there's volatility, because usually the greatest opportunity in terms of making profits and trading happens during large scale volatility events, right? It's more of just the first reaction. Well, we don't really know what's going on. Let's pull out, let's assess what's going on, and then get back in. And so if you introduce these speed bumps, where if the markets are down 10 or 20 or 30%, I think actually it can help the markets, a great deal. And you have this on the CME right now, right? So the CME Bitcoin futures, they have these, speed bumps. Maybe they're a bit too tight. But at the end of the day, I think they can make a great deal of difference.
Yeah, you referenced this back early in the episode, but you talked about BTC kind of breaking that correlation during Asian market hours. So we've had guests come on and talk about the Eastern market, and I wonder if you could give us any insights if because that was a great one. But do you have any other insights on kind of the Eastern market, the Eastern investor, and how that kind of relates back into the crypto economy or universe as a whole?
Yeah, I think the Asian markets are definitely a lot less regulated than the U.S. Sitting especially in New York, most of the time, which is one of the more regulated areas even in the U.S. I feel like a lot of products and innovation happens more so in kind of the Asia markets and the participants, right? And so especially in the option space, we're seeing just a ton of more use cases and usage in terms of structured products from the lenders, borrowers, and miners in the space, with options, right? We're actually seeing like double no touch, digital options that are getting priced and used and packaged. You see the structured products that are, quote unquote, providing like 3% baseline returns, and if the markets don't move, more than 20% in 3 months, you get like 20% yield or something. But underneath the hood, you're actually seeing these products get created with these kind of exotic options. And a lot of this comes from traditional markets. They've existed for decades. They're just kind of repackaged in crypto now. But these products are a lot more common and used for Asian counterparties and users than they are here in the US.
Yeah, absolutely. I love that. The exotic options side of it, is definitely quite popular in Asia. In the one touch or two touch, options or the contracts that get structured, you try to find a counterparty that would do this, and apparently, there is enough. I guess counterparty is willing to to kind of deliver that product to you. So and a lot of people, traders, the retail side, they'll be like, well, is this if we see an options that's being bought, let's say a call option or whatever, or put options, a lot of them, right, this is bullish or bearish, they'll think like, oh, okay, the institutional guys that are in derivatives, they look at the put to call ratio, let's say it's like really low, then they're saying, oh, okay, the institutional side is like really bullish on Bitcoin. But that's not necessarily true, right? Because you can use kind of creative things like you've explained, where you can maybe perhaps have even the short position in the futures, collect funding, and you can buy call options to hedge some of your short, and you have interesting structure there where you buy a call option, sell a call option, and then hold a short position, collect funding, offset of that cost. It becomes like a free insurance, right? Like those things are very creative, and a lot of times the retail participants kind of understand, like, they think they see one piece of information, they think that's the bias of the institutional side, that's to the upside. What is your kind of advice to like some of the traders that might be looking at the information, interpreting when they're trying to determine where's the institutional side? Is it biased? Is it neutral? Does it take the neutral side of the market where they just, if volatility happens, they make money. If volatility doesn't happen, they kind of make a little less money? Or do they actually have a bias, short or long?
Yeah. I mean, it's a lot of the times it's kind of just information overload. I think, especially if you're, talking to retail investors, I guess it's just, especially if you're a retail investor, the best bet is actually not to try to interpret all these various, informations that are kind of getting thrown at you, right? If you're looking at like put call ratio and you're looking at, I don't know, funding rates, and you're looking at like open interest and all this stuff. Yeah, I mean, at the end of the day, it's a ton of noise, and nothing's going to be 100% hit rate. Like even for us, that we're ingesting this data, for every asset out there in crypto, and a lot of times our quant models aren't necessarily accurate either, right? And so, I would say just stick with what you know. Try to limit your leverage in terms of using some of these products. Nothing is going to work, 100% of the time. And I think at the end of the day, if you've got a long-term outlook for the space in crypto, and you think that it's going to survive and grow as an asset class, then, really a lot of the times, you can't even do better than just, dollar cost averaging or just buying on dips, or just, slowly kind of accumulating, Bitcoin, right? So, yeah, I mean, even professional traders get it wrong. So I think, your best bet is to just not pay too much attention to kind of the noise that that inevitably is around you.
So you're saying I shouldn't go 100x long on anything on BitMEX then? Okay, sounds good. As far as kind of the outlook for the industry, I did want to kind of break out from the options and everything we've been touching on here, and kind of look at the industry and what other sectors you see within crypto that you kind of are interested in or that you think might be undervalued. I know we talked on DeFi and got your thoughts there, but is there any other sector kind of in our crypto universe or blockchain space that really interests you?
Yeah, I think, and this is going to be maybe controversial to I don't know, Bitcoin maximalists or the pure crypto users, but I'm actually really excited about just how the stablecoin markets have grown and kind of connected average day individuals and users and use cases to crypto, right? I mean, even this year I've made 2 personal investments that are venture investments, angel investments, using stable coins, right? And it was a really extremely pleasant experience. Fred Wilson from Union Square the other day say that he makes golf bets using USDC as like a average day-to-day kind of use case. And broadly this year we've seen kind of Tether as a market cap and use case in terms of transaction volume surpass Bitcoin on a daily basis, and it's kind of the fuel that's underlying a lot of even global trade between various large corporations, right? Between corporations in China and Brazil, let's say. And so I'm actually pretty excited that yes, it's still these are stable coins that are backed by fiat, and for better or worse, but they've actually acted as this great bridge for crypto to kind of the average world. And I think it's I don't know, it's almost like a quote unquote gateway drug for crypto, right? Once you kind of learn and understand stable coins and stablecoin technology and the rails of it, from that you can kind of access other cryptos and use cases and start to learn about DeFi. But I think first and foremost, it's acted as a great kind of bridge between the 2 worlds.
Absolutely. Yeah, I love that topic about stable coins, and I've heard people that we've interviewed before say, why are we pushing, something that's very volatile, and try to push the market to get into these volatile tokens when they can just start with stable coin, no volatility, just get in stable coin and, it's backed by fiat and here you are, right? And then kind of take one step at a time rather than, try to figure out this DeFi, lending, all this like wallet creation, all this crazy stuff, right? So, but the question that I have about, stable coins, we've been kind of talking about this with our guys, as where we are as far as the global situation goes and with the interest rates, kind of, at zero, basically, with these stable coins, when, if they become more popular, right, the market cap is going to grow, then they're going to have more reserves in cash, which is they're going to have to keep that at the custodial bank, which, eventually might actually start charging them for the deposits, right? So that's kind of like a risk for these stable coins where, if they're going to start getting juiced on these deposits, then how, are they going to be staying in business basically, right? What is going to be the structure there? What do you think about that situation?
Yeah, I mean, absolutely. I think to a certain extent, the stablecoin market exists because of regulatory arbitrage, right? It exists because governments or central entities haven't necessarily blocked it or stopped it or prevented it, right? But I think it's mutually beneficial, right? To the extent that these stable coins are backed one for one by fiat, at these banks, the banks are benefiting to a certain extent from having this large cash reserve, often, US dollars, because that's kind of the most often used and backer of stable coins. And so, these banks in turn are able to monetize, from this kind of reserve pool of dollars that are backing these kind of, stable coins, right? And so I don't necessarily see it as, I see it more as beneficial, currently. But yes, absolutely in the future. Right now, it's just our regulatory arbitrage. If governments and whatnot start to step in, then that's a completely different story.
Awesome, Shiliang. So this was a great episode. Obviously, we loved having you. One last question we always have for our guests is a book recommendation. Could be crypto, could not be crypto, nonfiction or fiction. What is your book recommendation for the viewers and listeners out there before we wrap up?
Yeah, let me. I'm just started reading this. Let me grab it. Yeah. So I've read this before, obviously, but it was just great to read again, given everything that's kind of going on. It's not new, but the Sovereign Individual is always a great one that people quote all the time, and kind of rereading it is always kind of just brings a lot of interesting things that are applicable from back when it was written to what's going on now, and so highly recommend.
Yeah, it always piques my interest when books kind of pop up in multiple interviews. So I think Sovereign Individual has popped up in one or two other of our interviews. So definitely have to get my hands on that one. But before we wrap up here, last thing, drop your links to where the viewers and listeners can maybe find more about you and then LedgerPrime.
Yeah, we keep a low profile, but certainly you can find me on Twitter at Shiliang Tang, and LedgerPrime, LedgerPrime.com. Always. There's our contact on the website, so always feel free to drop us a note. Always looking for talented individuals with strategies, ideas, that can be deployed in the crypto market. So if you got an idea, feel free to drop us a note.
All right. So like we said, great interview. We'll definitely have you back on here in a couple months or maybe some 4, 5, 6 months down the line and see where the DeFi space has gone, see where the institutional side of crypto has gone. So again, thank you for coming on.
Yeah, thank you. Thanks a lot.
Hey guys, we hope you enjoyed today's episode. Make sure to check out Layer 1 on all the audio and video platforms listed in the description. Thanks for stopping by, and we'll see you next week.